What kind of a client suited for this particular product?
I think you need to ensure that what is your expectation from the product. Important thing is you need to know your drawdown. That is the key message which we had ensured that we communicated to clients because it's a new category.
Yes.
For the investors, for the asset managers as well as the distributors, the category is not even a year old yet. So we will not have any a naked equity kind of an exposure. On our covered call position, we go ahead and we buy protective puts. We've defined it at say 3%. So the maximum drawdown which we can have on a stock specific position in a caller strategy is 3%. Now SEBI mandates you to keep minimum 25% in hybrid long short in the debt as debt exposure. Now for us, we are entirely a high quality credit, AAA kind of a credit portfolio. Everything which we've modeled in the last 1 year or so for this strategy, it is being integrated into our BlackRock's internal model, internal software, which is nothing but Aladdin. Again, why we are not taking direct equity is we believe that the investors who have to take direct equity are taking it through a lot of other traditional mutual funds.
Hello everyone, welcome to Nirmal Bang podcast. I am Ritu Poddar and today we are going to talk about PRISM strategy by Jio BlackRock mutual funds. So let's understand its philosophy, how it is going to navigate the different market scenarios and what it matters to the clients and how clients can incorporate this strategy in their portfolio. So let's meet Mr. Arun R. He is a CIO, SIF, having more than 2 decades of experience. He is a seasoned professional in fixed income market and managing many treasury-based strategies in current market scenarios. So happy to have you here, Arun. So Arun, before getting into the PRISM and talking about the PRISM fund, what thought came into because there are many traditional strategies are there. What led you to launch a multi-strategy fund?
I think if you go back a few years since the debt taxation law had changed, the tax efficient avenues for an investors have come down significantly. And there has always been kind of a product gap between maybe an arbitrage fund or a fixed income kind of a product and an active equity product. And there were very limited avenues for an investor. The ones which were there had limited access and they were not tax efficient, maybe a PMS route or an AIF route, where neither were they tax efficient, not accessible to everyone. And this product fits into that gap. And that was one of the reasons for this product coming up and SEBI launching this category, SIF, to ensure that that gap is filled.
Okay, so as you talked about the SIF as a category, and you said that there was a space which was needed, the new product probably. What kind of a client suited for this particular product, and how they can probably pick funds which is good for them, and because there are the multiple categories and different categories within.
Yes, I think you need to ensure that what is your expectation from the product. That is something which people have to be very clear on. These strategies are not active equity strategies, but that doesn't mean they are completely unrelated to equity market movements. There are certain strategies which could be derivative in nature in products. There could be certain strategies which could have high yield credits. So you need to know the underlying product and your expectation from the fund before you can go ahead and invest in these strategies. Important thing is you need to know your drawdown. That is the key message which we at PRISM have ensured that we communicated to client. You need to know your drawdown because it's a new category.
Yes.
For the investors, for the asset managers as well as the distributors, the category is not even a year old yet. So it's a new category, and that's why the drawdown or the downside, to understand that in whichever fund or strategy you might invest, knowing that is very essential.
Okay, so you talked about the PRISM. I was just going through the presentation and I saw this is not a single strategy based fund. There are the multiple strategies you are using. So what all the returns, basically return engine in this particular strategies?
So what we are following is we have what we call strategies. We call it sleeves. So the first one which we are launching is the Prism Hybrid Long Short strategy, which we will have. Now it will have 5 sleeves or 5 strategies.
Okay.
Now this will be a mix of something which we call as collar strategy. Then we will have merger arbitrage. We would have REITs and InvITs, which comprise on the hybrid and equity, and the fixed income strategy. So the fixed income, again, that will be predominantly AAA in nature for us. So that would comprise around 25% of the portfolio at the bare minimum, and the remaining 4 strategies which I just mentioned.
Okay, so is this just because of the low correlation between these sleeves, what you said, or how it is?
Yeah, end of the day, diversification is the key because we are not taking directional calls, as I said. So we will not have any, what you say, a naked equity kind of an exposure. We will not be getting into those positions in the fund. So the strategies which we have, we've tried to remove market risk as far as possible and give a total return fund kind of a product. And the strategies which I've mentioned, we've backtested it for the last 4 years. The reason being REITs and InvITs as a product category have been there in the Indian market only since the last 5 to 7 years. So we've backtested it for the last 4 years, this composition, and we found out the correlation is very, very low between any 2 strategies. In fact, it is also negative between certain strategies. So that gives you the confidence that yes, we will be able to perform irrespective of the market cycle.
Okay. Because mostly when we talk about the asset classes, we see low correlation is sometimes, changes in different market scenarios where we need it the most.
True.
So have you checked this kind of a scenarios also within your strategy?
Yes, we've checked it, and we also appreciate that we've tested it, we've back tested it. The live environment could be difficult as we go forward because situations can change. So what we've done is intentionally each of our exposure, what we've tried to do is we've tried to remove the market beta out of the play. For example, if we have an exposure to a REIT or an InvIT, what we do is for each and every REIT InvIT exposure, the beta of that stock, we would go and buy a put against that. So we remove the market risk out of that exposure. So that is also one way of ensuring that these correlations stay in place and are stronger than in most market conditions.
Okay. So you said whatever the stocks and all you buy, against that you buy the put.
No, stocks would only be REITs and InvITs because they are still, end of the day, they are still classified as shares. Although the structure might be different, but they are still shares, they do have some component of market risk.
Correct.
So those are the only so-called equity, direct equity exposure. We will not have any stocks just because the sector or the stock looks good. We won't have such exposures.
Okay, so there won't be any kind of a direct equity exposure. Okay, so as you said, there are the different factors. So let's talk about what all those engines you have said. You said that collar strategy. First, just wanted to understand because I think many of the audience don't understand how you can generate returns through that.
So before we get into collar, there's something called as covered call. So collar is just one step added to the covered call strategy. Now covered call strategy is nothing, you have a particular stock or a share, what you go and you intend to hold that share for a long time, but you also want to earn something out of that position. So what you do is you hold a stock, you go and write a call against that. When you do that, you get the call premium. And upon expiry, that's what you earn. This is nothing but a covered call strategy. But the risk with a covered call strategy is what if the stock which you own starts correcting?
Right.
Now you are only immune to the extent of whatever call premium you have collected. Beyond that, your losses begin to, you start to incur losses on that position. And this is why we, as I said, we want to immunize as far as possible any kind of market risk in this strategy. That's why we are not going for covered call. What we are doing is on our covered call position, we go ahead and we buy protective puts.
Okay.
So that limits your drawdown to any exposure which you might have on covered call. So in this case, we will have the stock, we will write call against it, and we'll also go and buy a put option on that stock. And of course, the put strike price will have to be defined. We've defined it at say 3%. So the maximum drawdown which we can have on a stock specific position in a caller strategy is 3%.
Okay.
So that is how we've defined our risk limits.
Okay. So here, what kind of exposure you will take in your strategy of column?
Okay, so the composition could vary. The ideal scenario, we would like it to be around 30 to 35%.
Okay.
That is the ideal scenario if you ask me on a portfolio composition point. But again, we are constantly on the lookout for strategies. There could be events when a merger arb opportunity could be more attractive than a caller opportunity. We might increase a merger arb allocation a little higher vis-a-vis caller. So we are pretty nimble from that point, but caller strategies on a steady state should be around 30 to 35% of the portfolio.
Okay. And what about the rest strategy? Like if we'll talk about the special situation thing, what would be the allocation in that? And basically, there are the lot many, special situation events keeps coming. How do you identify whether it's a genuine opportunity or it's a kind of a value trap?
So special situation, we haven't really defined it in our sleeves.
Okay.
Because that is not going to be part of our core strategy.
Okay.
That will be more opportunistic in nature. You could have some kind of a rights or a buyback kind of an issue. Or those are the instances, or an IPO flip kind of situation which could arise. But that's not going to be part of our core portfolio.
Okay.
What we would have instead of that is something which will be part of the core portfolio is a merger arb opportunities. Now you can put it as a special situation kind of a strategy, but we have defined specifically merger arb as part of our core portfolio.
Okay.
Again, in terms of composition, that will be between 10 to 15% on a steady state basis. We expect total merger arb component in the portfolio to be around 10 to 15%.
And if you can help me to understand just what is merger arbitrage, how you will find out the opportunity in that.
So merger arbitrage, put simply, is if you have two companies, company A intends to acquire company B, then one prerequisite is that the acquiring company should be in the futures market. It has to. So if that is the case, then what we do is once the swap ratio is announced after the merger announcement, once they get those clearances and a swap ratio is announced, there are times in the market when there are merger arbitrage opportunities wherein the price between the two fluctuate. And because the swap ratio is announced upon consummation of the deal, the price will merge. But it is it's like your spot future plain thing, but over a longer period of time. So what you do is you go and buy stocks of the company which is going to get acquired, and you short the shares of the company which is the acquiring company.
Okay.
And you hold it over the period of the merger. It might take 6 months, certain cases it might take 9 months to 12 months. But eventually, once the acquisition is completed, the prices will converge. And that is the return which you make. It removes the monthly rollover kind of risk which you have in a plain arbitrage or even in a collar strategy. So this is a more elongated kind of a strategy within the portfolio.
Okay. So one is your collar strategy is a part of your core. Second is your merger. And what would be the rest?
So rest would be, we would have active allocation to REITs and InvITs.
Okay.
Now, yes, there are challenges when it comes to REITs and InvITs in terms of volume. While as an asset class, there is no denying that they've had a phenomenal run in the last 4 to 5 years.
Correct.
And there is still a lot of interest and a lot of value in these REITs and InvITs. But yes, volume sometimes is a challenge. But again, we would have it as core of our portfolio, and as and when opportunities arise because there are new listings which are happening, a lot of unlisted entities in this space are now getting into the listed space. So the opportunities will open going forward as well. And we are constantly on the lookout for good opportunities within REITs as well as InvITs. So again, these two strategies put together, we intend to keep it around 15 to 20% of the total portfolio.
Okay. Okay. Within that, these strategies, you told that certain allocation you have defined internally. But how do you ensure that one strategy is not overlapping the others? Because in certain markets you get so many opportunities to invest into.
Yeah.
And in some markets you just you have to figure it out where to invest and where to park at least the funds. So how do you ensure that activity?
So again, that's where the disciplined approach comes into play. So everything which we've modeled in the last 1 year or so for this strategy, it is being integrated into our BlackRock's internal model, internal software, which is nothing but Aladdin. And that's where the risk management is of key importance when it comes to BlackRock and Jio BlackRock AMC and the PRISM SIF. That's where the discipline and deviation from whatever the principles which we've laid down, we ensure you have to keep within your strategies have to be within those limits. And even in this case, in case of an SIF, there could be opportunities when maybe a merger up is looking more attractive, but we have strict norms of any particular merger up, you cannot have more than 6% of the portfolio. Okay. However attractive that is, you cannot go cross 6%. Even in case of collar strategies, while you could have 8% into a single stock collar strategy, but that exposes you to concentration risk.
Okay.
And so internally, our threshold there is 5%. So there cannot be more than 5% of a single stock collar strategy. So minimum stocks you need to hold in collar is 20%. That ensures diversification, that ensures discipline. So however attractive one collar might be, you are capped at 5% exposure to that. You will have to take the next best opportunity.
So means Aladdin, as you said, that is help you to at least on a risk side basically to maintain the risk and the portfolio construction side as well.
Yes. So Jio BlackRock, I think the heart of the AMC and the SIF is risk management. Eventually, everything revolves around risk management.
Okay.
And same is the case here, right from identification of callers. So you will have a universe of 100, 120 stocks. Now you will have to select 20 out of those. You will have to identify the correct strike price wherein you write those caller strategies. Okay. Right from that to risk monitoring to stress testing of your existing position, everything is done to a single platform. And that's what is the core of the PRISM SIF.
Okay, wonderful. So you're just about PRISM hybrid long short if we'll talk about, and if we see the market scenario where last 2-3 years market doesn't move, suppose, how this strategy will generate return and what kind of a returns, if you can tentatively help, or what kind of a strategy probably in that scenario can help to generate returns?
I think that precisely is the kind of market which will help something like our long short hybrid strategy, wherein the market is in a very narrow range or without any significant run up. Because as I said, we don't have any direct equity exposures. Right. So ours is going to be kind of a total return strategy. The covered call strategy or the collar strategy does extremely well when the market is, in a very narrow range. Yeah. That's when you get maximum value out of those strategies. Merger up is again market neutral kind of a thing, because eventually it depends on how many opportunities you get during the course of the year, how many mergers are happening. So that is any which way is market neutral. For REIT and InvIT, again, it's a completely different set of play, different risk to be assessed in that segment of the curve. And of course, the 25% plus fixed income part, again, is completely market neutral from that, equity market neutral from that angle. So such a market, the fund will be extremely competitive, wherein a total return kind of strategy would do very well. Now, in terms of the return expectation, as I said, we started this talk. It fits in between something which is an arbitrage fund and an active equity fund, or even a balanced advantage kind of a fund. So that is where we want to position this product as. Because again, why we are not taking direct equity is we believe that the investors who have to take direct equity are taking it through a lot of other traditional mutual funds.
True. Okay.
So we don't want to, replicate a similar strategy in this one. This is a completely total return kind of a fund, which is not entirely depending on, such directional equity exposures.
So you have few factors. You said those are like few strategies are which is market neutral. So in case of bull run or suppose bear phase, um, in any scenario where probably this fund will underperform or outperform, because as you said that volatile market, definitely this strategy will be a very competitive. But what about the bull and bear phase?
So in terms of underperform or outperform, if you're mentioning about peers,
Yes.
then you also need to assess, because there are multiple strategies within the hybrid long short strategy when it comes to peer positioning as well. The very simple example could be we in our debt portfolio. Now, SEBI mandates you to keep minimum 25% in hybrid long short in the debt
Correct.
as debt exposure.
Allocation.
Now, for us, we are entirely a high quality credit, AAA kind of a credit portfolio for our SIF. There could be peers who have different policy on their credit exposures. So that differentiates us. The reason being, again, we don't want to expose investors on a high yielding credit in this fund, because they can do it in other traditional mutual funds where it's possible. For us, we will not be doing that. And in terms of performance, bear versus bull, I think, as I said, market neutral is what we've tried to achieve here. We are trying to achieve here that's why each and every exposure we are removing the market risk.
Right. Okay.
So the idea is to remove the market risk and give you a total return kind of a performance.
Okay. So on the risk side, if I'll talk about, then what is the area where the prism is more vulnerable and in terms of risk?
So it is vulnerable because end of the day, as I said, even in our collar strategy, now while we are buying the protective puts there, but those protective puts get triggered at maybe 3%. So you do have some kind of a drawdown. But the idea is to communicate the kind of risk which the investor can see in the fund. So that's why, and the fact that it is a very well diversified portfolio. It's not going to be 60-70% in one strategy, and then which exposes you to different levels of drawdowns which you did not anticipate. Plus, because we have these 5 sleeves, and the correlation between them, as I said, is very, very bare minimum. Across market cycles we've touched. Case in example could be if you've seen Jan, Feb, March, as recent as 2026, Jan, Feb, March, equity markets were pretty weak during that quarter. And we have backtested then. We had a live portfolio running in terms of a paper portfolio during that period. And the strategy really played out there, wherein the correlation or the lack of correlation for that matter was really evident in kind of the backtesting results which we could achieve there, even in the paper portfolio, and even backtesting it to the worst period, which could be maybe December to Feb 25, which was again one of a very weak period for Indian markets. We backtested this strategy during those periods, and it has given very good results. So that's why we are very confident on the diversification and lack of correlation.
Okay. So within this product or within the SIF, one thing is very clear. I think the risk, to understand the risk, is very important for the clients rather than returns. So once you will understand the risk, then probably the return expectation any which ways would moderate. Or what do you think?
I think it's true for any investment you do. I think you need to understand the risk before you invest. For any investment, doesn't matter whether it's SIF, it's long equity, it's any debt product, anything. Unless you understand the risk, informed investor would not really appreciate kind of, you need to know what risk you have taken to generate that return, right? And that sets the expectation, right?
Yeah, but in plain vanilla product, basically equity risk is generic, like equity risk. Market will be volatile, so the equity products. But here within the strategies or within the categories, there are so many different products are there.
Yes.
Suppose you are saying you are not taking the direct, some other might take, little exposure in the direct equities as well to enhance the return. So to understand the strategies, I think would be very critical part within the SIF.
Yeah, one, to understand the strategy. Two, within the strategy, what kind of drawdowns is the fund exposing you to? So both those things. So in terms of strategy, as I said, we are a completely AAA kind of a strategy. So we have very less credit risk vis-a-vis someone else who might have a higher yielding credit. So that's one risk you identify. Yes, that will give you that additional few bases in return because you are getting a higher accrual on your debt. But then that also exposes you to a credit risk. Two, there are funds who are doing covered call strategy, as I said.
Yes.
We are doing collar strategy. Now, when we are doing collar, we are buying that insurance in the form of a protective put. We need to pay that charges for that put. So that does impact the return expectation as well. So that's why you need to assess within the product, within the strategies also, what are these finer nuances.
Correct. So finally, for the product point of view, if I'll say investors' portfolio, where it fit in basically, it should be a part of core portfolio or the satellite portfolio.
Oh, this certainly has to be part of your core portfolio. Absolutely no denying. Imagine if you had something like this, a product like this 3 years back. Wherein 3 years, last 3 years, if you look at the equity returns, if you look at index returns, I don't think it is as in line with what a lot of people would have expected or would have wished for.
Yes.
The next best opportunity then would have been maybe a tax efficient opportunity would have been an arbitrage fund, which have done pretty well. But again, there could have been something better than arbitrage, which are arbitrage plus plus, which investors would have loved in the last 3 years, an avenue or an access to such a strategy. So it should be part of the core portfolio. We certainly see a lot of scope in SIFs going forward. And the product is just gaining traction, and we are pretty sure that once we have a reasonable track record, a lot of interest will automatically get generated into these strategies.
Okay. So thank you, Arun. Thank you for helping us to understand the product and understand how we can position this product within the client portfolio. Thank you so much.
Thanks.